Hi everybody, it's Nick Jevick, and today we're going to talk about how to structure your investment fund. And this topic came about as a result of a conversation that I had with a friend of mine who is a successful real estate investor. And he's finding himself in a situation where he's got many more opportunities and he has capital. And so he wanted to better understand how to go out and raise money from private investors to fund his real estate transactions. And so as we got into the conversation, what I wanted to understand was whether he wanted to raise money on a deal-by-deal basis and go out and find a transaction, find a property to acquire, go out then and raise the money for that particular deal, and then keep doing that, or whether he wanted to go out and raise a fund, and so raise a pool of capital, or also known as a blind pool, and then use that money to make investments. And it was the latter of the two that he wanted to do. So that's what we're going to talk about in the next two videos. In this first video, we're going to talk about how to structure your fund and how these funds are put together. And then in the second video, we're going to talk a little bit about the economics, what carried interest is, what a waterfall is, and how that works. So let's get into the first presentation, and I hope you enjoy it. Thanks. So what is an investment fund? As you recall in the introduction, I wanted to understand from my friend whether he wanted to raise money on a deal-by-deal basis or if he wanted to have a pool of capital that he could deploy as he found opportunities. And so an investment fund is where you want to raise a pool of capital for investments that have yet to be identified. And then these investments get made over time. And because the investors don't know what investments will eventually be in the fund, investment funds are sometimes also known as blind pools. Investment funds are typically established as limited partnerships so that the investors come in as limited partners and then you as the sponsor are the general partner. And the role of the general partner is to manage the activities and affairs of the fund. Sometimes the general partner is the investment manager, and sometimes the investment manager is a separate entity. So what we're going to look at over the next several slides is how the general partner can be structured and what the relationship is between the general partner and the investment manager. This first one is really the simplest one, and it's where the general partner is formed as an LLC, and the general partner and the investment manager are one and the same. The second structure is one that I've seen only a few times, and it's where the general partner is formed as a limited partnership. And then you have an investment manager that's a separate entity, and it's usually formed as an LLC. This investment manager then is the general partner of the fund. The dotted line that you see between the investment manager and the fund represents a contractual relationship between the two for the investment manager to provide investment services such as sourcing transactions, negotiating the deals, performing due diligence, closing transactions, and then doing portfolio management. This final structure is one where the general partner is formed as a limited partnership or as an LLC. And then the investment manager is a separate entity without any relationship to the general partner. And again, the investment manager here is set up as a limited liability company. And again, with that dotted line showing the contractual relationship between the investment manager and the fund. So fund mechanics, it's interesting. A lot of people think that when you close a fund, you collect all the money, you put the money in the bank, and then you deploy that money over time. But that's not what happens. So in other words, you close in a $5 million fund. At closing, you're not collecting $5 million in checks from your investors and waiting for opportunities, but instead you'll be pulling down just enough money to cover some management fees, which are typically paid in advance, closing costs, which are primarily going to be legal fees, and then if you have any pending investments, you're going to be drawing down capital for that as well. Other than that, the funds are going to be really in waiting. They're going to be commitments that you're going to draw down from your investors as you find opportunities. In this slide, I just want to pull the cover back a little bit on what we're going to talk about in the next video, and that is the leverage that's available for the general partner of a fund. And so you can see here that typically the capital invested in a fund is 1% from the general partner, 99% from the limited partners. So in our example of a $5 million fund, the general partner is going to invest $50,000.
But the share of the profits is split 80-20, with 80% to the limited partners and 20% to the general partner. So you can see the huge leverage potential that's available for the general partner. So that's what we're going to talk about in the next video. Sponsor economics, what carried interest is, and then we're going to talk about what the waterfall is. So until then, it's Nick Jevick. Take care.
Okay, so that was video one. Hope you enjoyed it and hope you found it informative. In the next video, we're going to talk about the economics of a fund for you, the sponsor, what a waterfall is, how that works, and what carried interest is, and how that works to your benefit. So we'll see you in the second video. Take care.